for the invite. Thank you for the invite and to talk about investing strategies with you guys. Very grateful. I tried to put together something for us just to talk about investing and of course investing strategies vis-a-vis if we're in the US. 35 slides, but they're all important just so we can tell a story that is very, very useful to both parties, right? So first of all, start with the disclaimer. Everything here is illustrative, educational. It's not investment advice, not an offer, and all that kind of stuff, right? Consult your advisor before investing. So just very important that we put it out there for you guys. And then what are we going to talk about today? And we are going to talk about the principles of investing, an overview of the US and global markets, and of course, how to invest in these asset classes, the bonds, the foreign stocks, and of course, alternatives. How do we invest in them? And then we're going to talk about this is my icebreaker, more or less, random walk. And this is all literally all tied back to investing, right? First of all, don't fight the trend. Very, very important. Don't fight the trend. If the markets are going up, it's always a good idea to swim with the markets. There's a strategy called being contrarian, but if you don't know what you're doing, don't, right? So don't fight the trend. Past is prologue. What this means is that whatever happens in the past is not going to work in the future, right? Especially in investing. Even though the stock has performed the same for, say, 20 periods, you cannot rely on that and just say the 21st period will be good. It's always looking at the fundamentals that is in front of you. Past is prologue, very important, but we have to look at numbers in front of us, right? So nobody knows what's going to happen. You see the guys on CNN, on Bloomberg, on whatever show it is. We are all reporting on data in front of us, but we don't know what's going to happen. No one saw the Russian invasion. Nobody saw COVID. No one saw the 2008 recession. We don't know. We can seem to have an idea, but we really do not know. So it's very, very important to keep this in mind, right? He that has more will get more. So it's just a rule. If you have more money, you can make more money in investing. I didn't make the rules, but just the rule for us to be aware of. And everybody's going to get a chance, right? And in the gold rush, try not to sell gold, but try to sell the shovel. So if you are investing in the plumbing, it's also a great idea, just like if you are investing in the gold itself. So that means in the markets, if there's crypto, you can invest in the guys that do the crypto servers. That's also a good way to make money, even a better way to make money than actually buying cryptocurrencies. And of course, there's nothing like luck in investing. It's all labor. You must have invested or bought something for that price to have gone up, right? So it's all labor under control knowledge. So very, very good point for us to note as we go along, right? And sometimes my system does freeze and all I do is just to get out and come back in and I'll be just dandy, guys. All right. Sorry, it's going to take us back a bit. So this is where we are, right? I'm just trying to lay the foundation because I'm assuming not everyone is an investor, just to bring us all up to speed, just so that we can follow, right? So principle of investing are basically three. Who are you? What's your objective? And what's your risk profile? Every time you want to invest, you want to basically answer these three questions. So because everyone is different, then everyone's going to have a different investing style. So who you are has to do more with your financial lifestyle. Your objective basically determines your asset allocation. And we're going to talk about all this in the text, right? And of course, the risk that you take determines the investment selection that we're going to basically apply. So everybody in this group, listen to this, is going to have a different strategy because everybody is different. Everybody has a different objective and everybody has a different risk profile, more or less. So these are the questions that we essentially ask you. If you go to any advisor, they're going to try to find out from you, what's your objective? Are you doing a capital appreciation or are you doing capital preservation? Which means, do you want to invest your money that the money you are investing should grow? Or do you want to invest your money and just make income on that money? So Capital appreciation is talking about shares like equity, buying stocks, right? If you buy one share of Tesla at 100 Naira, that share of Tesla could be worth 300 Naira, which means your actual principal has actually expanded, right? But if you buy bonds, bonds don't expand your credit. They only pay you interest on what you've invested. So appreciation vis-a-vis preservation, that's going to be the two differences there. Then of course, what's your risk profile, right? Can you accommodate risk? How much? How long are you investing for? And of course, how old are you? These questions, sorry, I think, have you guys seen, I know you guys seen my slide. I am on slide 6. Is that what you guys are seeing, please?
Yeah, that's what we're saying.
Great. Okay. So if you answer these questions, it tells me the kind of investor you are and what instruments I can refer to you. So everyone is going to be different, but there's something just come up immediately. If you are above 60, for instance, then you cannot invest in, say, equities or have a larger proportion of your funds in equities. Why? Because equities are appreciation, which means there's a higher amount of risk. That's essentially what happens. If you are older, you are doing more of capital preservation, which means you are taking less risks. That essentially is what this investment is all about. Some things we can tell you off the bat, some things would have to ask you questions. And when you answer these 4 questions, we can then give you a better sense, right? And these are the asset classes we're talking about. Going from left to right, the risk increases. Going from right to left, the returns reduce. So asset classes are essentially all this kind of stuff that you can invest in, starting from cash to government bonds, to municipal bonds and local government bonds, to equities, large cap equities, then to penny stocks. As you go from here, from 1 to 5, your risk increases, but your potential return also increases. So when we say we want to find out who you are and what your objectives are, this is what we talk about. If you are an older person, then you're going to stop at 1, 2, 3, maybe some 4, but not a lot of 4. 1, 2, 3, and some 4. But if you are younger, you're going to do 5, 4, and 3. Not a lot of 2, but 5, 4, and 3, because your age determines that you can take a larger amount of risk. So an investment plan is very, very customized. There's no one size fits all, but we'll see a few options for one size fits all as we continue. And this is essentially what we're talking about here, guys. So if you came to me and you had 10 years, you had more than 10 years to retire, right? I would then advise an aggressive that you can invest here. So you can see 50% is in stocks, 30% is in alternatives, things like crypto or art, that kind of stuff. 20% only is in bonds. This is a very, very young person. He has more than 10 years to retire. Compared to this guy that is in retirement, he has a bulk of his cash, 30 in cash, 40% in bonds. Bonds just give him income, then only 15% in shares and alternatives, right? So the point is, it is who you are that determines the investments that you make. There is no right, there is no better investment. There's no which investment is better. No, it's who you are. Are you older than you are conservative? Are you younger than you are aggressive? How long do you want to invest? Do you have 10 years to invest? Then you're a bit aggressive. Do you have less than 10 years to invest? Then you're a bit moderate. Those answers tell us essentially what you can invest in. So no investment is better. Stocks are not better than bonds. It's customized to who you are. All right, guys, you guys can come off mute and tell me, this is a car. What can you guys tell me about this car? Not the car itself, but what's happening is the car. What can you guys see by just looking at this?
Monitors, dashboard,
Yeah, but what's the monitor saying?
danger, red light warnings.
What else?
You're literally not moving anywhere in a hurry.
But so I can tell just by looking at this that the car is standing still.
Yeah.
Is the engine hot or cold?
About average.
It's a car that's been running. It's a car
It's
that's
not
been
running, right? The car isn't
Well,
running. There's no power in the engine. How much gas does it have?
midway, half tank.
Half tank. And we've not seen this car, right? But we can simply looking at this picture of the dashboard tell that this car isn't moving. And if we know where this car is, if we know this car is in, say, Virginia, we can actually tell if this car can get to Washington. We can actually tell by looking at the fuel gauge. We can tell if the car has been used by looking at maybe the heat, is it hot, is the engine hot or cold? But right now, no power going through the engine. We can tell all this without seeing this car, touching this car, even seeing the picture of the car, by just looking at the indicators on the dashboard. This is the same with economics and investing. If you read the indicators in the economy, the unemployment rate, the inflation rate, they tell you the same thing about the economy. Is the economy going to go into a recession? Is the economy going to go into a boom? What does the interest rate say? Are people applying for unemployment? It's the exact same thing that we're doing. But investing is now even getting worse because this car is telling me that I have a half tank. If I was in Texas, I know I cannot drive to New York with this car. It's not possible because it has a half gas tank. But in investing, it's now becoming different. An investor right now will tell you that I can drive, doesn't matter. What do I mean? The guys on Wall Street bets. I'm making this point because when we have talked about investing in the past, we have always looked at the fundamentals, inflation, fundamental sales, and all that. But the world is changing because of this new internet craze. You've got people on Robinhood, and you've got people investing. What that means for you is this: when you are investing or you are trading with people that are not looking at fundamentals anymore. I give an example. Hertz was bankrupt, but the price of Hertz kept on going up in the market. The Hertz put a big boulder there. This company is bankrupt. It is worth zero. And still, the guys were buying. This is an interesting point to know because if you are going to trade or invest, you have to have a plan and you cannot look at the market to make that plan for you because people are going to buy and trade. This is Wall Street bets. These are also indicators. This chart is showing that Apple has high, which is green, positive sentiment, but that NVIDIA has a lot and very, very low negative sentiment. I think this is Boeing, very, very high negative sentiment. This has nothing to do with fundamentals. This has nothing to do with sales. It's just what the internet is talking about. But just as we saw that car, that the indicators on that car can tell us about the car, this has started to become a new way of investing. By just knowing what the internet is saying or talking about, I can know where to invest. This is an interesting point for us to know so that when we are looking at indicators, it's not just the hard numbers that count, but the soft numbers. Investing is like a beauty contest. It's not who you say is beautiful that wins, but who everybody else says and votes for that is beautiful that wins. We have the same with crypto, same thing, BTC, positive. And that's why people are buying because everyone is talking about it. Has nothing to do with fundamentals. Same thing here, Wall Street bets, this is who they're banking on. They want to buy NVIDIA, they don't want to buy Roku, they don't want to buy BYN, they don't want to buy Alibaba, no. They don't want to buy Amazon. They're interested in Apple, Disney, NVIDIA, and Uber. It doesn't matter what Uber is saying really, but this is what the market wants to buy. So when we go to our first slide, we said, don't fight the trend. This has now become a very, very big trend in the market. Wall Street bets and online crowd buying the dip. taking money and on Robinhood with credit and buying. So you have to look at this as a part of a quote unquote fundamentals on how you choose where you invest in. We talked about your risk profile. We talked about your investment selection. Now we're talking about your financial lifestyle. It's also very, very important. Which leads us to this chart. You will always hear people on TV say high interest rates means stocks fall. Stocks fall means high interest rates. The point is, again, like I said, nobody knows. If you look at this chart, this is the federal funds rate. This is basically the rate that you get from your bank. And every decade, you see the starting and the ending. So you can see this, guys, the rates went up in the 74s, but the market, the S&P went down. So rates up, stocks represented by the Standard & Poor's index went down. Look at here, rates went up, markets boomed. So same thing, rates went up, market down. Rates went up, market up. 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 There is no rhyme or reason. There is no rhyme or reason. You can't go with what has happened in the past to invest. And this is a bit clearer. Stocks, bonds, and cash. Stocks, negative, bonds, positive, cash, positive in 1930s. Today, stocks, 13, bonds, 4, cash, 0.5. Only in the 70s did cash, just holding cash, outperform investing in stocks or bonds. But if you look across, essentially, you can't really tell me if this goes up, if bonds go up, stocks go down. If stocks go down, bonds go up. There is a general relationship, but essentially, there is no correlation. There is no defined positive correlation between if stocks go up, bonds go down. The rule of thumb is higher interest rates affect stocks. That stocks go up with high interest rates, some stocks, but that bonds suffer. But then again, we don't see it in the numbers. You will see some correlation, but we don't see it in the number. Again, with this guy, stocks, inflation. Inflation high, stocks high, inflation was high. Stocks low, inflation low, stocks were low. Inflation low, stocks were high. So again, no rhyme, no reason. But the point is that we have to read those indicators and know where to invest. So now, guys, I've shown you how we invest, that nothing is good, nothing is bad. I've also shown you that when you take a larger amount of risk, what we call volatility, it is the volatility that is your return. So if you buy a safe bond, a US government bond, because there is no volatility, there is no return per se, as compared to buying equities that the price can go up and down. It is that volatility that creates that return. But if you are younger, you want volatility because you can ride the wave and obviously make some money because your capital can appreciate. But if you are older, then you don't want the volatility because you might lose all your principal at the point that you're retiring. This is the differentiation. This is what we're talking about. But I'm making again the point that you can't use any formula to invest. If you invest because inflation is higher or lower, or bonds are higher or lower, that may not be the issue. You have to have a plan. You have to say, I want to invest in this and this and this for these years to make this return or this objective, and then I'm going to exit. That has got to be how you want to do it. It's a bit easier. I'll make it a bit easier for you guys. So there are just 4 phases that you have to know. Every time you see a market, it's either at 1, 2, 3, or 4. The market is either just catching its breath, which we call accumulation. And there are things that you do in an accumulation, right? And how you measure an accumulation. If you look at the last column there, the 200 M&A, this guy right here, this is the moving average. So if you're a technical guy, it says that this stock's going up and down. There's an average price. So today it was 5, tomorrow it was 4, then it was 6, then it was 1. So prices go up and down. But what is the average? This is what we call the moving average. If the moving average of the stocks are flat, like here, then the market is catching its breath. It's an accumulation. So this is just where the market's accumulation. Then you see the market then start to go up. It's advancing, in which case the moving average price now breaks above the average, an uptrend, right? Then it then falls, it can go up and then flatten. So it's down, it went on and people sold and took shares. People are distributing property themselves. Then it declines again. This is where you become a long-term investor. You don't buy a stock, right, when the price is going up. You don't buy here. You buy here or here, right, or not here. So every stock, every market would have this fall. Your job is to find out where the stock or market is. If you know the market is here, then you're not buying. Because if you're buying the stock that is going up in price. You should have bought here, rather, I say. You should have bought here. If you buy here, you don't know if you're buying here, which is very good, or if you are buying here, in which case you are buying at the top of the market. You want to try to buy at the flat or at the beginning of the advance. How do you know where to buy? When you do your calculations of intrinsic value, your fundamentals tell you when to buy. So what is happening in the world right now is that when the market gets here, the Wall Street bet boys start to buy or buy here and they take it up and they do what's called momentum, because all you are having here is just hype, right? It's the hype that takes the market up, then it flattens and then the boys sell, then it crashes. So if you know where the stock or the market is, then you can get in. So for the traders, this is very, very good for them. For the long-term guys, you don't care. You don't care. The market is here, 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 here. You don't care. You want to buy a good stock at a good price. If the market goes up or down, it's irrelevant to you. You want to buy a good company at a good price. What's a good company? A company that is generating earnings into the future. That's a good company. It has to generate earnings. If it's generating earnings, it's a good company. Apple is the biggest company in the world because it is generating earnings. All right, guys. So I just want to just come back to, I think we're going to have questions at the very end. So just have a question and I'll try to make it, trying to compress a lot of information into you guys in a few minutes, but so just please forgive me. So this is, I tried to give you guys a 10-year. Someone's going to ask a question. So what plan should I have? So I've talked about who you are determines where you invest. Let's look at over 10 years. Over 10 years, what investment? These are all the investment options you could have put your money into. US stocks, US property, foreign stocks, that's Nigeria right there, foreign developed market stocks, US junk bonds, treasury tips are for inflation, US bonds, foreign bonds like Nigeria. So we know we're here, we're emerging markets, or we're emerging market government bonds, or commodities like gold and oil. Where should you have invested your money in 10 years to make the most return? If you look at the return here, the best place for you to put your money into to invest over the past 10 years has been US stocks. So US stocks over 10 years have beaten every other type of investment in the world. That's 14.2% US stocks. Volatility is the return, i.e. the risk. So look at the high return, but of course, high risk, right? The next asset class that has performed the best in the world has been US property, returning about 9.3% in 10 years. Then you then have the foreign developed market stocks, the Nigerias, the Indonesias, and all that. The Nigerian market was the best performing market in 2020. That was driven by just one stock, Dangote Cement. That's the largest stock in Nigeria. So it went up and then the entire market went up. So this is just on ascending order. But look at commodities. This year, just keep an eye on this. For over 10 years, commodities like oil and gold has been the worst performer. But this year, commodities are the only stock that are actually making a profit. This was taken last week. So just by last week, we then had the other commodities because of Ukraine, then had the wheat and all those other commodities jump in here because of Ukraine. For beginning of the year, before we had the war in Ukraine, only crude oil had returned a profit. You compare that to over 10 years when commodities had been negative. So imagine if you were an investor and you go like, oh, because oil is returning 52%, I'm going to invest all my money in oil. 10 years ago, it was zero. This year, 2022, almost half of 100% right there. Dollar also going up higher because of risk in the market. So everybody is running into, should we say, safety of the US dollar. What's not doing well? Bitcoin here, as you see, at minus 5.2 is actually doing pretty well because it's come up from negative almost 25 back to negative 5. This is driven by, again, Russia, Ukraine. Folks are trying to put their money in Bitcoin, right? Stocks have been horrible this year, down 6. Government bonds are going to do worse than this. High corporate bonds are going to do worse than this. And of course, investment grade bonds will do worse than this because the interest rates are going to rise from the Federal Reserve. And when that happens, it pulls down the returns on bonds. Guys, because I have a lot to share, I'm going to stop here at the end of part 1. Let me take at least 1 or 2 questions, right? Something that's bugging your mind before we then go in and talk about the actual asset classes. We'll show you guys the sort of the preview, how the markets interrelate, how you cannot depend on trends, but how you want to have, should we say, a plan. Let me take at least 2 questions before I continue, just so we can catch our breath and all. Let's go for it, guys.
So anyone has any questions, please, the floor is open. Oh, okay, I
Yes,
guess
sir.
if no one, go ahead. Who is this?
It's BIM. And
Okay,
so I'm
go ahead.
Plantino, but I don't have camera. Quick question. Will you be talking about portfolio allocation? I mean, equity versus other as part of this. It's not ready to, not general, not necessarily pertaining to the presentation, but will you talk about portfolio allocation anyway?
All right, so should I don't think I got that. Should I go ahead? I'm so sorry, guys. Hello?
Oh, the question? No, the question is, would you be addressing how we should think about portfolio allocation, different, I mean, equities versus bond versus anything? Yeah, okay, thank you.
Yes, I'm going to get to that. What I'm trying to do is to lay out the framework that a portfolio construction has to do with the individual person. So if you give me an example of who you are, I can construct a portfolio for you. But what I've also tried to do, especially on this chart here, was to show you the general outlines that you can take based on your age, right? So if you are a younger person, this is like where you want to start from. This guy right here, you're an aggressive investor based just on your age. Age is a very, very good way to construct a portfolio because there are some hard guardrails around age. For instance, if you are getting to 60, if you are getting to the age of retirement, you want to be here. You are either going to be moderate or conservative, which means that you want to put the bulk of your funds in either bonds or income generating investments. You are not looking to do the bulk of your funds in stocks. You're looking at property, not to buy the property, but to get the income from the property. So this is this slide that I will basically rest on. You can then tweak this slide to be more specific to the individual. But with this slide, it gives you the general outline based on age and based on your attitude to risk on how you should invest. This is what I want to do, right? If you want to get something more specific, you'd have to give me your specific, and I'm going to show you how you can send it to me. I have a website, you can go in there and it can do this for you, or I can send it back to you as well. I can give you a specific asset allocation, but for now, this slide will have to suffice because I don't know your specifics, but this is the whole criteria. Your age and your attitude to risk will define a portfolio of these common asset classes. If you are younger, you are doing stocks. If you are older, you are doing fixed income. The word is income. But for your younger, the word is appreciation of your capital. Does that address that a bit, sir?
Yes, sir. Thank you, sir.
Okay. All right, so I think the next stage I want to talk about is just to introduce ETFs, because we're going to talk a lot about ETFs. I'm not assuming everyone knows about ETFs, so I'll just introduce them so that when we talk about them, we can understand better, right? So ETFs are essentially, they're like stocks, but they're also like mutual funds. They're just, they behave like a stock, which means you can buy them or sell them during the stock market, right? But they are also a collection of funds, like a mutual fund or what we call Nigeria unit trust schemes. So when you mix a mutual fund and a stock, you get an ETF. The exact same thing, you can buy an ETF for just a specific location, or you can buy an ETF for a specific industry or even a specific risk that you want to track. So ETFs are just like unit trusts or mutual funds, but you can trade them during the day, just to introduce that concept to us. So now what I want to do is to talk about specifics now of the asset classes. So I'll talk about bonds, I'll talk about equities, I'll talk about probably fixed income and all that, so that you can understand the asset classes. So when you want to build your portfolio, you then know which ones to put in your portfolio based on these asset classes. So we're going to start with bonds. And what are bonds? When someone borrows money from you and gives you a piece of paper called an IOU, that's a bond. So when you invest in a US bond, you are lending money to the US government. If you invest in a Nigerian bond, you are lending money to the Nigerian government. So the same thing, if you want, let's use AFMS analogy. If the overall saw you one day and said, oh, I think I'm hungry, give me your bread and I'll give you bread tomorrow. You know the overall always gets double ration. So you know he's good to give you a loaf of bread. You trust the overall. I mean, he's the overall, he can't lie, and he'll always give you his other ration. So you give him your bread without question because he will pay you back. The overall is like the US. US will always pay you back. Even if they have to print, they will pay you back. But if you're investing with Zimbabwe just can't print dollars, so they can't just pay you back. So you would demand a higher rate of return from Zimbabwe than you would for the US. That rate of return is your coupon. So the higher the coupon, the more the bond earns, but the bond is also risky because Zimbabwe can fail, the US cannot fail. So high interest rate bonds are called junk bonds, not because they are junk, but because they pay a high rate of return. The higher the rate of return, then the more suspicious, in quotes, we are of that bond. So it pays us higher, but we are suspicious of it because it pays us higher. So look at the bond performance here, guys. This is US bonds. US bonds to date. Which ones are paying the most, right? You have the title here and the index here. So these are short-term inflation index bonds, STIPs. Why are they doing the best in America? Number one, because they are short-term. So nobody wants to invest for the long-term in America because we're not sure of where the economy is going to. Is there a recession? Is there a stagflation? We don't know. So because we don't know, we're going to put our money for short durations. And again, this is inflation hedge. So we like it because it's inflation hedge and it's short-term. Look at the ones doing the worst, long-term. Long-term. We don't want anything long-term in our portfolio because we don't lock ourselves in. And look at all the guys doing badly. TLT, 20 years, 10 years. So the longer the term, the worse it's doing. We don't want to be long-term. We want to be very, very short-term, and if possible, be in inflation index bonds in America. This is the whole idea of the bonds, not just the returns, but the duration. So the longer the duration, the less profit you are going to make, because people don't trust to invest in the long term in America. I pulled this up, guys, just to show us the returns. If you were a guy, so now I'm talking about the asset classes. We're talking now of bonds. So bonds are income. So if you are buying bonds, it's because you want income. These are like, I pulled this up. These are all the companies in America that would pay you the highest return. Some are stocks, some are bonds, some are REITs, but they pay you the highest return in terms of a dividend. So it's very easy to find them. Just pick the ticker here, write it out, and then just look on your computer, either on Robinhood or whatever app you want to, and then you can just find them. So if you, for instance, if you say CUBA, it will give you this guy. It's a financial, so if it's closed end, it's hard to get if it's a closed end. But if it's a REIT and the rest, then you can find them. So these are going to pay you the highest rate of return in America. Very important, as inflation is about 7.9 in America and rising. So when you want to invest, for instance, in this, you are seeing that, listen, this is the line 6, this is the average of the market. Even at this, these guys are not even paying you 1%. So the return from this US bonds and all this fixed income is not even up to 1%. So if you're looking for income with at least more risk, then you want to then dive into these guys that would pay you an income. Some are stocks and all that, but this pays you income and they will carry a higher amount of risk. Also, if you're looking for income, you should also consider Nigeria, because Nigeria has got what we call Euro bonds, which are essentially Nigerian government investing or borrowing from Wall Street. Why are they pretty good? They are paying as high as 8.75. So if you buy those bonds, you are getting a dollar return of 8.75. So it's high risk, high return bond, right? But you have to have for Nigeria a minimum of 200,000 to buy that bond. So the way you can buy that bond without having 200,000 is to buy a USD bond fund. Lots of Nigerian companies have them. This is the one from FCMB. As a legacy bond fund, minimum is about 1,000 or 1,002 and all that. And I'm going to show you a few, but they are all all Euro bond funds. They are all investing the same thing. They are all targeting that Euro bond fund that pays about 8.7. Some have a lower coupon, but these allow you to earn a very, very high return on your dollar savings, right? On your dollar savings. So this is from Stanbic as well. You can also invest in a Stanbic dollar fund. So it's the same thing. And let's just go back and just make sure we clarify what we've done. If you want to invest in bonds, how I've done these presentations, I've shown you guys how to do an allocation. We're now going to talk about the different asset classes. So if you're investing in bonds, I've given you the general overview for bonds. And you can see that the shorter duration bonds are the ones that are doing well, but even these guys are not giving you any return, not even up to 1%. You can go higher by investing in equity-linked instruments that pay you higher, but the risk here is very, very high as well. Or you can invest in Nigerian Euro bonds that will pay you the highest, of course, have the higher risk, but Nigeria has never defaulted on the bond. You have legacy, you have ARM, and of course, you have Stanbic. So these are all for the bond investors. Let's go to the guys that want to take risk, the foreign stocks investors. And just like we've done, let's again look at this guy for 5 years. I showed you guys a link for 10 years. For 5 years, who has done the best in the world? US stocks for 5 years. What about for 1 month? Commodities. Only commodities that are doing well, crude oil, gold, and all that, they are the only guys doing well. For the year to date, again, only commodities. Inflation-linked bonds, just less than 1%. So you can just see the market move in the short term and the market move for 1 year. Look at US stocks, they were 11% a year ago. Now they're down 2.5, right? So the world right now, there's this Ukraine crisis has brought in a lot of uncertainty. We don't know what's going to happen. And when we don't know what's going to happen, then markets suffer. It doesn't like uncertainty. And I'll give you an example. Look at crude oil. 5 years, -5. 3 years, -11. But 1 year, up 63. 1 month, up 8. Year to date, up 24. Same thing with gold. So gold is 8 and it's up. Dollar, nearly flat. So there's just, you can't compare 3 to 5 to 1 month on crude oil. It's just all over the place. But look at the stock market, up 15% 5 years ago, 3 years ago, up 18%, 1 year ago, up 16%. But now, year to date, down 8, and a month ago, down 3. So this is all to do with the uncertainty of inflation, the wars, and all that. That's what we're seeing. So where do you want to hide? You can hide in bonds and get less than 1 or 2%, or you can take a risk in equities and see if this will reverse in your favor. You have to decide based on your age, your risk profile, and your objective. That's essentially what we're talking about here. It's a good way to visualize the market. If you don't really know how to look at the market, just go to your computer and just type heat map for the stocks, right? And you can do this for stocks or for any sector you want. Just type heat, as in heat, H-E-A-T, heat map for the stock market. The bigger the box, the bigger the company. So this is year to date. Microsoft down 13. Apple down 8. So they have a big box because they're the largest company. So Apple is the largest company in the world or in America, so bigger box. Google down 8%. But just visually looking at this map, lots of reds everywhere. And that just tells that the market is suffering. Where do you have all the green? Right here. Energy, ExxonMobil, Chevron. Warren Buffett just bought Occidental Petroleum, right? In here. All green. This is where the market is basically moving in here. Where else do we see green? Here, aerospace, Lockheed Martin, all those anti-tank missiles in Ukraine. This guy is right here. So this is just telling you, when you look at this market, just look at it as a visual. You just say, wow, the market is doing bad here, doing bad here, doing bad here. This is Facebook. This is Berkshire Hathaway, up 8 percentage points. This is PayPal, down 47. So you can just tell what sectors are doing well, which ones are not doing well as well, and just tells you what's going on in the market. Nike down, restaurants down, Tesla down, everybody's down, right? And just shows you what's going on. So if you want to invest, you take a peek at the map and see what's going on. I pulled this guy as well, the same map, but I'm pulling indexes because someone asked me, can I allocate and how can I invest? This is the same map, but this is based off indexes, like I showed you guys. So VTI is stocks. You can see they are red. SQQ, these guys are inverse. So these are, you are buying this to go opposite. You can see that they are green. So the opposite to the market making money is SQQQ. So you buy SQQQ if you think the market will crash. And you can see the market is going up because the market is crashing. So it just tells you how sophisticated and wide the market is. That it's very difficult to try to pick and choose. Energy, XOP, they only buy energy stocks. These are commodity stocks, so they are doing pretty well. Then this XOXL is the opposite of energy doing well. You can see it's going down because energy is doing pretty well. Tech, semiconductors doing very, very bad. Look at gold is up. Precious stones and metals, gold up, energy up, crude oil up. Every other thing is going down. Look at government bonds, all red. So the point is, you have lots of options. You have lots of ways to lose money. So what's an easy way to invest in the US market? Easy way. You don't know anything about investments. You don't know anything. Just how can you invest your money easy and monitor it and track it? I have a plan for you guys. You can do this, right? This, I call this the Rip Van Winkle portfolio. Rip Van Winkle, as you know, is that guy that slept for 20 years, right? So he slept for 20 years. So what can you invest in today and go to sleep for 20 years and come back and you're still good? This is the portfolio for you guys. You have equity, you have bonds. Just buy two. Buy the VTI. VTI is only going to buy you US markets. Then the VXUS is going to buy you equities minus the US markets. Same thing with bonds. BND is buying you bonds in the US market. BNDX is buying you all bonds minus the US markets. So all you have to do here is to allocate how much you want to go. If you have $100 and you are younger, then the bulk should come here. So if you put 80 here, how much should go to the US? We've seen that the US for 10 years has been the best performing market, but we don't know anything. We don't know what's going to happen tomorrow. So how much do you put in the US? How much do you put in international? Same thing with bonds. If you are old and you want to invest here, so how much do you put in bonds? How much do you put in international? There is just a simple way for you. So 4 companies, just choose all among them. And you can recreate this. You can buy a VT or VOO, but it's the same thing. You're buying only stocks and you're buying only bonds. And you're buying stocks in US or international or bonds in the US or international. If I was a 50-year-old guy, right, in the US right now, and I had to invest, I would put, give or take, about 60% or 70% of my money in bonds. In equities, about 70% of money in equities. And I will put out of that 70%, about 80% of that money in US stocks. So I would do 70% here. Then when I get in here, I will do at least 70% in US. And I'll, of course, put 30% here. Why am I doing 70% here? Because this is where the growth is. I'm still kind of young. I'm 49, so I can do more risk. I can take some risk here, put some money in here in VTI, put the rest here, 30% here, so I can catch Nigerian growth right here. Then I also buy insurance by buying bonds. So I would just come and just buy US bonds. I'm not going to waste my time with international bonds. I would do maybe out of 100%, do 90% in US bonds here. Then here I would do a bit high interest, high risk. I'll buy Nigerian bonds here, buy US bonds here. So this way I've invested in everything, invested in fixed income and variable income, but I've allocated it to capture the growth of the US market. And of course, the growth, the Samsungs, the China are going to be here. Same thing here, I'm buying safety because bonds are safety, right? So I want to buy the safety, but I also like some returns. So I might buy some Nigerian bonds here. So the Euro bonds are going to pay me 8%. I'm going to buy some here. So an easy, simple way to invest, guys, by just doing this. But let's talk about alternatives, because even what we just talked about, Rip Van Winkle, is just traditional bonds and shares. What about the non-traditional assets? Are they going to be there for us? Yes, they are. Cryptocurrencies. Never ignore cryptocurrencies. It's now becoming a thing. The largest hedge fund in the world, Bridgewater, is going to increase their exposure to cryptocurrencies. Every bank from Citigroup to Goldman is going to do cryptos. Whether you like it or not, it's going to be a thing. And we don't know what's going to happen tomorrow, but at least we want to put at least 5 or 10% of our money in crypto. And crypto is very, very confusing because some are useful, some are just nonsense, right? Like if you pick a stock like Bitcoin, this is green, so this is just for payment. It's a currency. So Bitcoin is currency. Bitcoin also allows you to store money in case of inflation. That's what Bitcoin does. What about Ethereum? Ethereum is what they call a smart contract. So they are used to like build contracts. You tell a computer, say, if Kalu comes for a meeting, charge him 2 cents. You build that with Ethereum. But Bitcoin is basically what you pay, right? So these two, Bitcoin and Ethereum, are the leaders technically. But all these guys you see all do something unique in that whole ecospace. Look at cryptocurrencies as the internet being rebuilt. And all these guys are the building blocks. To build a house, you need timber, you need piping, you need ceramics. That's essentially what all these are. So you want to buy the Bitcoins, yes, but you also want to buy the guy that is doing something very, very important. Like in your house, the hinges The nails, you don't see them, but they're very, very, very important. You see guys like EOS, right? They are doing the utility and the transactions. Those guys are the white papers that are very, very important. This allows you to basically say, I'm going to do some crypto, I'm going to invest. I personally, I don't waste my time. I don't know this stuff. I just buy Bitcoin and Ethereum and I stake it. Staking means I just take it and I give to the exchange and I just earn a fixed income from it. I don't trade. I'm not that good in trading. I have lots of trading signals. If you guys want, I can send to you weekly, but I just take my Bitcoin, my Ethereum, and I stake it and I get returns as high as 9, 8, 7% fixed on those staking. It's high risk, but it's better than leaving that money in a bank. That's how I look at it. So that's basically what I do with cryptocurrency, just to give me yield. Guys, we're at the end of this guide, right? All I can do is to talk to you guys about how you should invest. You have to follow it this way: 1, 2, 3, 4, and 5. So this is an error. You can't jump. You cannot start to invest at 4 until you have, first of all, set up an emergency fund of 3 to 6 months of your non-discretionary. Non-discretionary simply means expenses that you must make: food, rent. You must keep them, keep a cash float of 3 to 6 months of that. Then if you have dependents, you must buy life insurance. So if you are married or you have kids, you must buy life insurance. I'm not suggesting, I'm saying like an order, you have to buy life insurance. Then you have to do your retirement plan. It's only after you've done 1, 2, and 3 can you start to invest, right? Because these are more important than investment returns. Then when you are investing, you can then talk about buying a mortgage. I did a series once about buying a house in 36 months. It's on Twitter. If you guys want, I can share it. If someone has, you can share it step by step, how you can buy a house in the US in 36 months. It's doable, it's doneable, it's just using the steps and you can basically get there. So guys, this is the last pages. My book, it's out 31st. It's already in review in Amazon. So if they find no issues with it, it's going to be out. It's powerful. Even though I'm recommending it myself, I think I packed it in with about 20 years of knowledge, practical guidelines, US and Nigerian issues that will basically teach you guys lots of stuff. I do a podcast. I YouTube every week. I'm on Twitter. My website is wonderful because you can go in there. Most of what I've told you guys about how to invest, you can ask, you can go do the financial health check. You'll do your income and expenses for you and all that kind of stuff. And you can basically just learn. I try to do a learning site, guys, on that. So I can hand over now and I'm done. If anyone has any questions, that's what I'm here for. Thank you so much, guys. Juniors can stand up now. Thank you, sir.
Kalu, thank you very much. This was quite informative. I guess before I open the floor for questions, can you make this slide deck available? Sorry to put you on the spot.
Yeah, I'll send it to you. I'll send it to whoever. Send me an maybe to or whatever. I'll just send an email on it. Yeah, that's fine.
All right, good copy. Okay, so I will open the floor now for questions. If anyone has any questions.
Hey, Kalu, just on your last slide, I think the last few slides you had when you got to cryptos and the rest of them, I just wanted to know what are your thoughts on NFTs?
Yeah, they're hype. But remember, when I say they're a hype, doesn't mean you can't make money from it. Cryptos are the children of high liquidity. So the point is, because there's high liquidity in the world, then people have to spend, right? So people create apes and say the ape is worth $100,000. It's nonsense. But if you buy that ape for $100,000, you can sell it for $200,000. So the Wall Street always says, do you want to argue or do you want to make money? If you want to make money, you can buy those things and it goes up. But it's a gamble. It's based on the greater fool theory. And it's an actual theory, the greater fool theory. So if you get lucky, because there's nothing fundamental about it, if you get lucky and you buy an NFT that's going to rise in price, boom, you can make money. NFT, we can make an NFT with AFMS logo. And if we start to sell that NFT, it makes money. Remember when we were young, we had comics, some comics, Commando comics, some of them were worth 10 other Commando comics, just because maybe they had a German shooting or they had more bombs. That's an NFT. So nothing fundamental about it. Doesn't mean you can't make money from it. But as an investment, I wouldn't touch it, right? I could trade it, but I wouldn't buy an NFT and keep. No way. It's hype. Once recession hits, that's going to be the first thing that'll be wiped off. So if you want to trade, like I said, it's something you can take a peek at, but there's no practical use for it. Later on, people might do NFTs of contract and to be unique, blah, blah, blah. But for now, no.
Okay, thank you, sir.
Okay, any other questions?
Yes, Oga Kalu, thank you so much for taking the time to explain. I have 2 questions. The first question is Forex. Which Forex would you recommend someone to trade in? Either be in Nigeria or here in the US? Because I know there's a Forex going on right now called Omega Pro, and I've been tempted to get into the Forex business, but I have my skepticism regarding that. That's one. The second question is stocks and bonds. When it comes to the retirement age, do you recommend going aggressive or just to use the goal maker for you to build whatever stocks and bonds that you want to do for your retirement? Thank you.
Yeah, so the first question is easy to answer. Omega Pro is a Ponzi scheme, right? So don't put your money in it. All those, there are lots of them. There's another one called Intelligent Prime Capital. They're all Ponzi schemes. And they are paying the rates now because they're building up the trap. Once they get what they want, they'll close down and run away. The same guys in Omega Pro are the same guys that did a scheme that crashed a few years ago. So I would advise you put all that give us one less trade for you. It's all a scam. No one can trade profitably forever. So any scheme that promises you a return on trading is already a scam. What's his name? Madoff. Why it was a scam was promising returns, which are impossible. You can't promise a fixed return because you are trading. But if you want to trade currencies, you have to really study. You're trading development in the world, right? So you're trading currency pair. Right now, what currency should I show you people who are buying? US dollar. People are buying US dollar. Why? Because of risk. Because there's risk, everyone wants the US dollar. So if you take a risk and say you're going to sell US dollar and then the US market crashes, you make a lot of money. So it's a very complicated place. You are dealing with people that are trained and versed in this. So if you don't know what to do, I don't know, but it's a very, very complicated space that you need a lot of knowledge to trade in. What pair are you going to trade in and all that kind of stuff. I could send you a link on how to trade, how to train yourself and all. But for Mega Pro, Intelligent Prime Capital, these are Ponzi schemes straight up, right? For stocks and bonds, right? So the way I tried to approach it was to say stocks are for this and bonds are for this. This is also another good slide, right? So this is basically your whole universe, 1, 2, 3, 4, 5. And this is essentially where you are. You can pick it's like a buffet. You can pick 1, 2, 3, 4, 5, all of them. But the more you pick and the more you diversify, the more you reduce your potential blowout profit. If you just pick 20, 20, 20, 20, 20, cash is going to pay you 0. Treasury bills should pay you 0. These guys will pay you less than 1. So you can only make your return from here, right? So it's much better to concentrate in a particular place based off your age or risk. If you're a younger guy, I would say look at 4 and 5, right? And as you get older, you are the word now is to reallocate your assets from 5 to 4, then from 4 to 3. So you go 100% 5 if you're below 20. If you're also below 30, you go 100% here. Then as you get to maybe 35, you put 20% here. So you have 80 here. As you begin to get like 40, 50, you can maybe open up 10% here, 20% here, 80% here. That's a way to do it. So you start off from 4, and then you try to go back to 1. That's how you invest as you get older. There's no other policy or strategy that beats that one, because that one takes into account the reality that as you get older, you cannot take risk. You don't invest for return, you invest to meet an objective. And when you are older, your objective is to raise income, not to grow your capital. You can't grow capital when you are old. That time has passed. You should have done it when you were younger. So if you are 60, you should not have a larger amount of your portfolio, right, in equities. That's not going to be right. You have to have the balance of it in bonds and a few in equities. So you start from 4, then you go 3, 5, 4, 3, 2, 1 as you get older. So you want your portfolio to look something like this. This is essentially what we've done. Aggressive is younger, moderate, then conservative. Thank you, sir.
Thank you, sir.
Okay. Any other questions? Well, let me use this opportunity.
Bitcoin is up to 46,000, guys. We have a rally on our hands.
Well, I think the story
I have a question. Oh, sorry, go for it. Sorry.
Yeah, the story we have for the last 1 year is Bitcoin could crack the 200K ceiling.
If Biden keeps doing what he's doing, it will.
Okay, good copy. Yeah, Tunde, was that you? Go ahead with your question, please.
Yes, Oga Kalu, I just wonder where you are on investing in real estate, and if that's something that is a topic that you wanted to cover or somewhere along those lines.
Real estate for me was REITs. I'm very particular about real estate. Let me see if I can get the slide up again. Real estate has to be REITs, which means you are buying the trust, not the actual property. So you see where I talked about REIT here. I hope you can see my slide 17. US REIT. When you buy a REIT, you're buying the company that is a landlord. You're investing in a landlord. And you can buy a REIT for commercial or for residential or even a REIT in a particular area. I like REITs because you can buy and sell. Let's say you bought property now and you need just $1,000. You can't sell one room, right? And you have to go fix toilets and tenants. But REITs allow you to ignore that and get the return, right, from that. Your return might not be the same as what the landlord is getting, but you get less headache. And there are many ways to invest in REITs. You can do fund rise. There are many of this kind of apps that allow you to do, should we say, unregistered or apartments in Texas. You can do fund rise and like a private placement, and you can get into those apartments in Texas that pay a lot of money. Or you can just buy into Apollo that does massive malls all over across America. So this is over 10 years, this is the return they've done over 10 years, 9.3%. This is the entire world, guys. So US REITs are beating even foreign bonds, foreign and all that. Somebody will say Nigeria is going to give you more return. Yeah, but your building can get demolished and you have to get tightened and louser. So it's high risk, high return, right? So REITs in the US give you like a middle cap ground. You can buy 3 types of REITs. Go buy developing apartments in Texas. That gives you high return, but the property is crap. Then you can buy malls, which is going to be Amazon and the rest. So you are tapping into the growth of the American complex. They can buy high-end REITs for Fifth Avenue in New York as well. But having REITs, to me, I think you can buy 1 or 2 homes. But once you start to do more than 2 homes, that's a business, right? It's going to take all your time. So either you do that as a business or you buy the REIT. You really can't manage more than 2 or 3 properties for rent. It's difficult, So that's my take on property. If you buy property, you're not wrong. It's just, I'm an investment guy. It's more like how I look at it. It gives you more investment flexibility, more liquidity. Tomorrow you can sell all your REITs and retire, or you can use that as collateral. But property is a bit higher. I mean, inflation rates now is going up. So it's going to affect property and all that. I don't know, it's a bit funny, but this is how I look at it.
No, thank you so much, sir. I just have a really quick follow-on question. So there are websites that help you with, say, for example, you want to invest, say, $500, and you kind of specify how you want it to be invested. But what they don't sometimes do is give you the option to they only give you certain options on there in terms of where you want to invest and what markets. Do you have any suggestions around, sorry, I don't know if I cut out or if you can still hear me.
Yeah, I can hear you.
Yeah, I suppose my question is, are there any specific websites or search engines, or wait, I don't know if I'm using the wrong terminology, that can help sorry, that can help with, sorry, call keeps coming in because I'm listening to the Zoom on my phone and I'm kind of cutting the call off. Yes, if there are any specific ways that we can use a particular tool that can help us with that kind of level of diversity with our investments, or would we, for example, if we wanted to invest in Nigerian bonds, for example, would we have to open up a specific account and monitor it through that specific platform, or are there any sort of ways that we can do it all on one platform, if that makes any sense? Sorry.
Yeah, many apps exist. If you on the website, again, my website, I put there's a place resources. There are tons of apps there. You can do Passfolio, which I work with them, or you can do Robinhood. Well, in America, I like Robinhood. It's pretty easy to use. So you can, or Betterment, there are many in America you can use, and they're all, like you said, the same. The issue is knowing what to buy, right? Even on Robinhood, I buy Nigerian stocks via Robinhood. I buy the mutual fund at least. There's an NGX mutual fund that invests in Nigeria. That's how I buy Nigerian stocks, through Robinhood, and I buy that NGX as well. It's available on other apps as well. I think the thing is to know what you want to buy. To know what you want to buy, really, I think, is the issue with Nigerian stocks. So this, you have to know. Let's say you want to invest, right? And you've said, I want to invest in US tech. You can buy the US company directly, like an MSF or Google, or you can just go and buy the ETF. So if you buy the ETF, for instance, if you buy VTI, look at it, this is US index. This means that if you buy this, you are buying the index. The index is more like the collection, everybody. So this is like AFMS right here. VTI is going to be AFMS. But we can come here to US and buy just the squadron. So here I'm buying just technology, VGT. This is sector in the index. So if you don't really know what to buy, the specific company, but you think that, listen, this crude oil story is not going to go away, Russia is going to be sanctioned and we're going to pay for oil for the next 2 or 3 years. Great. You come and you buy crude oil, USO. This is the index. So you are buying the index, USO. You are buying XOP. This is the index that tracks oil companies, right? But if you know the oil company you want to buy, you can simply come here and buy XOM. The problem is that America has so many stocks, so many of them companies that it's difficult to find a needle in the haystack. That's why ETFs work. People just buy the sector and allow the sector to just make the money, because to try to find one company that makes money is very, very difficult. So some people would say, buy the sector first, then keep on studying that sector, and then you find a winner. And remember, these are all big companies. This is the S&P I'm showing you. If we did, say, Russell, which is more of lower caps or all those companies, then we start to see more and more and more companies pop up. So my personal recommendation is, that's why I always go with this Rip Van Winkle portfolio. If you don't know, start from the top, buy the VTI, start from the top. Then as you know, start to break it out and say, okay, I want to buy technology and all that. Then you break it out, I want to buy tech, I want to buy oil. And then when you now buy the tech sector, you can start to say, okay, I want to buy ExxonMobil in the tech sector. Because apart, it's difficult. I think it's this one I want to show you guys. It's difficult to actually track which ones that you want to get. Sorry. Yeah. So there are some companies here in Brazil, some in Chile. This is China. You really can't track all this. So I would advise the first thing you do is to buy the index. Buy the index, then work your way down. You buy the index, then you buy the sector, then you buy the individual company. So if I were to buy, I would buy US, which is the index. So I'll buy VTI or VT, which is the US market. V just means Vanguard. You can buy QQQ, it's just a different company. So you buy V, which is Vanguard. Then I say, okay, what sector in the US is actually doing well? We know stocks are doing well, but what sector in that stock is doing well? Oh, technology, the FANG guys. Okay, I'm going to buy the technology sector in the US, which is a VNQ. So I buy that tech in the US. Then I can then go and buy, say, Tesla or Microsoft or Google. So I've gone from index to sector to individual stock. That way you are sort of hedging your bets, because you could go buy the tech stock directly, you don't know too much about it, and then you lose money. But the experts are the ones buying the sectors and you're buying the country. So that reduces your risk of choosing the wrong investment ab initio. But all those stocks and companies is the same question I'm going to ask you. What's your risk profile? What's your objective? And based on your answer, they basically recommend for you. But you can do it yourself if you know what you're doing.
Very good copy. Thank you. So I guess for your Van Winkle portfolio, just to clarify something. So on that portfolio, those, I guess, are those tickers you have on there?
Which one?
The Van Winkle portfolio. Those are tickers, right?
Yes, that's a ticker. So if you look for that ticker, exactly, it gives you that ETF. So those are the tickers for the ETFs, correct?
All right, good copy. So those four are tickers.
Yes, those four are tickers. So like I said, it's based off, it's an easy way to do asset allocation, right? If you are younger, do more of the equity. If you are older, do more of bonds. If you do half and half, you are midway, right? So VTI is a ticker, VXUS is a ticker, correct?
All right, good copy. Okay. Any other questions from anyone?
Yeah, I have a question. Oga Kalu, thank you for the informative session. My question is, I think in your earlier slides, I think one of the first set of slides you shared, you talked about like how online perception of some stocks are beginning to be like a contributing factor on how it impacts like market trends. I'd like to know your thoughts on meme stocks. Like, how can one make the best of it? Are there like proven strategies out there that one could deploy in dealing with meme stocks?
Yeah, you're right. I mean, it's just a momentum trade. Meme stocks are real. You can't ignore them. You can't say because they are fake or whatever, then you won't buy them. So that's why I'm actually putting them up in my presentation. The point I'm making is this: in the past, if a company is being shorted, it's very difficult for them to not to fail. GameStop and what the other people that were those popular meme stocks, they're all crap. They're all they're dead companies. You can't have a company selling tech in the real world, right? They have offices, there's a GameStop in my mall. What's it doing there? My kids buy games on their phone. Those companies are going to die, but they've been saved now because meme stocks, those Wall Street bet guys got in there, bought them. The company made so much money that they were able to sell new shares at inflated prices, pay off their debts. Now they're buying a gold company. So this is reality. The reality is that these stocks that people say are going to go up in price are going to go up in price. This is the reality. If you try to sell Apple, if Apple has a bad quarter in China, normally their shares should fall. But if their shares fall tomorrow, Wall Street boys, bets boys, and the guys online are going to buy them. So that just tells us something called momentum, and that's how you want to play it. So when you see, if you see this chart, this might not be I took this chart on Thursday night. Whatever you see here, yeah, okay, you want to invest, yeah, go buy Tesla. It doesn't matter the PE or the price of Tesla. It just matters that these boys say they are going to buy it. That's just the point I'm making, right? So it doesn't matter if that girl is fine. If everyone says she's fine, she's fine. Your view doesn't matter. So what do? Well, you invest in Tesla. You try to buy it, then you look for when it's going up. So you know you're going to buy Tesla, but at what price? This is when technical analysis then comes in. Can you read a chart? Do you know what moving average is? Do you know how to use the RSI and all that? That's when those things now come in. If you know you're going to buy Tesla, then technical analysis then tell you when to buy Tesla. You can't buy the stock on the TA of it, but if you want to buy it, use the TA to get your entry price. Remember I showed you that slide about the 4 stages of every company. It applies to everybody, right? So even if you know that the stock is good, you want to buy it when it is going. If you are doing Tesla now, you want to buy it when it is going up. You don't care about the market price. So you don't care about 1, you don't care about 3. You are trying to buy it on 2. That's what those boys are doing. They don't care the price or the news, but if it's going up, they take it up, then they exit. So when it's coming down, they don't care. So this is how you want to trade meme stocks. You want to use if you don't know technical analysis, it's difficult to do it. But once you see that the volume has started to rise, then you hop in. You ride that volume. Once volume starts to weaken, you get off. It has nothing to do with sales, price earnings. No, it's just momentum. That's exactly how you trade it.
Thank you.
You're welcome.
Any other questions?
Yeah, sorry, I have a quick follow-up question related to that. So again, you've thanks for the breakout in terms of, I mean, I'll call it portfolio allocations, I mean, based on risk profile, age, and so on. But if you look within the equity, the stock category, let's say it's 30%. And obviously, I know this is not, I mean, investment advice. It's, I mean, we're having a chat here. What's your approach towards technical versus fundamental, which is something you've just touched on, right? So of that 30%, do you typically take a view that, look, 90% of it, if I'm buying Tesla, I'm going to hold for 5 years, and then 10% I'll kind of monitor the market, or is it a different mix? I'm just curious in terms of how you approach that, number one. And then related to that, I mean, especially on the technical side, what's your recommendation in terms of doing this yourself? How much of it do you do yourself versus, look, at some point I just have somebody manage and kind of think of all this stuff for me?
Yeah, great question. So FA and TA, that's fundamental and technical analysis, are just two different animals, right? So if I want to buy a car, and just to explain it better, if I want to buy a car, I look at the fuel gauge, how far the car can go per gas mileage and all that. But you never see a car being marketed on the torque or the whatever throughput ratio. No, there's a fine scale on the car, and it's sex is harder to sell the car because it works, right? And that's what technical analysis is. You are looking at the triggers of volume. So volume is the most important thing, right? So you're saying, if I have decided that I want to invest in the US, then I ask myself, what sector in the US with this administration for the next 4 years is going to receive a lot of attention? Well, renewables. Oh, okay, what part of renewables? Well, there's batteries, there's cars, there's solar, there's wind. Look, let's say I pick cars. So I'm picking Tesla. Tesla has just opened up a new plant in Berlin, which means that they've got more scale, which means they're going to expand their sales in Europe. They didn't increase their price. It's a juggernaut now. It's difficult to catch them. So I want to buy Tesla. When should I buy? That's when TA comes in. So you've already taken the decision that you're going to buy Tesla. TA simply tells you when to go and buy Tesla. That's if you are a trader. If you are a trader, that's what you do. If you are long-term, there are two ways to buy Tesla. You could do a Warren Buffett and say, I'm going to wait for Tesla to fall, then I buy. But if you waited for Tesla to fall, it's now 1,000. You will just close your eyes and buy, and you put a good company. Remember, a good company is a company that's going to pay you earnings in the future. If you buy Tesla today, it pays no dividends today. But will it pay when it gets mature? Of course. So if you want to buy it today and say you bought it as a long-term plan, you don't care, you're going to hold it for 10, 15, 20 years. When you retire, the price would have gone up and you can sell. That's also another strategy, right? So all TA should do for you is to tell you when to buy. It should only tell you buy this. I have personally a long-term portfolio and a trading portfolio. So in my long-term portfolio, I put all those VTI boys there, and I only buy dividend-paying stocks and ETFs. If it's not paying me a dividend, I don't buy it for long-term. Why? Because when you buy a dividend and you reinvest your dividend, you are reducing your cost of purchase. So the longer you reinvest your dividends, you are reducing that cost of when you bought that stock. You reinvest, you buy more at zero. You reinvest, you buy more at zero. And it's a dividend-paying stock. You are growing your portfolio at no cost. And it's also insurance. If the stock falls, dividends are your profits. So I have that one for my long-term. Use only dividend-paying stocks and only long-term stocks, right? My trading portfolio is where I'm doing my crypto people, my Teslas. So if Tesla got bad news, I buy it. If it goes up, I sell, right? So because I'm not buying it for long term. I'm just trying to buy, make a quick buck and sell. But now they're taxing, so I don't really do a lot of all those crypto buying and sell. I just buy it, wait after 1 year, then I try to sell it, right? But your second question, when do you use TA or do you use the FA? If you want to do TA, right, you want to have 10 buckets or 5 buckets. So you take $1,000, you break it into 5. So that's probably $200. That's so you're doing your minimum lot size. They want to say, how much can you lose, right? So you are going to lose only $200 for every time you trade. So when you want to trade, immediately you trade, you put a stop loss. So the stock market is the only place on earth that you can tell in advance how much you would lose. So once you trade, you want to say, how much do you want to sell at and how much are you going to get out of? You have to say before you get in. So if you want to buy, say, Tesla, and Tesla is 1,000, you say once it gets to 1,050, I'm selling. Once it gets to 980, I'm selling. So you have your upper and your lower band, and you actually key it into the computer. So it's not like you are, oh, I'll think about it. You leave it there and you go to sleep. You don't look at the computer. So once it goes high, you make 30%, it sells, you close that position and you go away. Don't be greedy. But what if it goes down? If it comes down and it hits your sell order, that means it's losing more than 5%, it sells, you go away. That means you only lost on that $200, 5%. That's all you can lose. So $1,000 breaking into 5, 200, 200, 200, 200, 200. You can only lose 5% per $200. That's your maximum loss. So if your whole portfolio, you lose 2 times, but you get 3 times, you've made 60%, you've lost 10%. That's how you want to approach it. You lock in the losses, you allow the profits to go up. So how low you want to set your loss is basically up to you. But if you do it that way, you know you can only lose $100 every time you trade. You can't tell the casino how much you want to lose. You can't tell stocks how much you want to lose. But with trading, it's possible with stop losses. That's how you want to approach it. So that way, you know, I have 5 open lots. Okay, I might do 2 lots on this trade, and I'm going to set my loss at 5%. I'm going to set my profit at 30%. You key it in, so set it on a computer, go to bed. That's how you want to do it. Does that work for you, sir?
Thank you, sir.
Okay.
All right, thank you, Agaka. Appreciate it. So any other last questions before we wrap up?
Yes.
Please
Yes,
go ahead.
I raised mine up. Kalu, this is Gus Olalere. Good evening.
How you doing, sir?
I'm doing well. Very wonderful presentation. I thought it was very, very detailed, and just goes to show that you know, whether it's in Nigeria, London, or the US, you know, the formula for investing and financial planning is all the same.
Yeah.
Well done. Very, very detailed. I just wanted to ask you a question, especially with your background, you know, in Nigeria, in considering the perpetual devaluation that we have of the naira. You know, and we all recall when naira was, you know, 165, 365.
Yeah.
The same analysts that were making projections back then are saying that the naira is going to be about, you know, $1 to about 700 naira at the end of the year.
Yeah.
And with that as a backdrop, where are you telling your Nigerian investors to invest to be able to shield them from the perpetual devaluation, inflation, you know, short of putting their money in dollars?
Yeah, there's no other way you can do it, right? So devaluation is the technical term for Nigeria inflation, that your naira is going to lose value. I've been saying it for about 4 years' time. The naira has lost the quote unquote store of value context. It's just now a means of exchange. So I tell people, if you're not going to spend your money within 90 days, don't hold it in naira. You know, even if it's as bad as buying the dollar and just keeping the dollar physically in your possession, it's better than holding in naira. And before it was like, okay, this might be a good idea. And now it's actually an order. It's actually a necessity, because let me give you Nigeria's case right now. The value of the naira is based on the price of Brent crude. That's the value. So our Naira is a derivative of Brent. If Brent goes up, Naira goes up. So what is happening right now is Brent crude has gone up big time. So Nigerian Naira should have gone up, but it's not going up. Why? Because our production, believe it or not, has come down. It's not come down because we're not producing enough. We're pumping enough, but people are literally stealing the crude oil. This is not, Tony Elumelu bought Shell's oil field. He pumped 100% on the oil field. He only got 5%.
Wow.
I'm not exaggerating. He only got 5. Not just him. Every other person. And the guys, the guys are in London. Those guys are Avuru that owns the Niger Delta refinery, Seplat. Same thing. It's in the papers. It's not rumor. The CBN governor said stealing of oil is unprecedented. Then President Buhari said we've lost about 3.47 billion on crude oil theft. So we're not debating if the volume is down. We're debating how much has been stolen. They are literally, that's why you see Shell, Chevron, all of them sold off all their on-land oil rigs. In Nigeria, there's no big major online again. They're all in the sea, the high sea. They sold everything off. And if you were a smart Nigerian, you'd have asked yourself, if Shell is selling, why are you buying? That was silly. I mean, why are you buying if Shell is selling? Because it doesn't, that's enough, makes enough sense. So oil prices have gone up. Nigeria is not getting the value because we have not, so we're not selling at that OPEC quota, yeah? Then we're in turnaround to spend the dollars that we do get to import PMS. And the figure is mind-blowing. It's 2.5 trillion Naira. This was before Russia. This was just the budget, not the actual spend. 2.5 trillion. So the picture is that oil prices are up. We have no refinery, so we import PMS. But we're not selling the 5% that we sell from the onshore is taken to pay for imports. The Nigerian budget, 100% goes to paying debt, not salaries.
Yep.
Debt.
Yep.
After debt, then salaries, then PMS imports. Before we talk about, let's even build a road. The roads we're building are all on debt. So China has stopped funding. China says no more. So the pipeline to the north for gas is very important. We're not building. The railways, we're no longer building. So because China has cut off the piggy bank, it says no more loans to Nigeria, right? So in that situation, why would you hold the currency that represents this economy I just described? It makes no sense. It's going to get worse.
Yep. You
can't ban Aboki FX. It's like saying you're going to close your eyes and you won't see the sun. The sun is still going to be there. So Naira, it's, in my view, the Dangote refinery will help to cut off some imports of PMS. But still, Dangote is paying for the PMS in Naira. So we're reducing the inflow, right? So the whole idea is if you don't stop imports, the Naira is worth nothing. So you don't hold Naira. The Naira account I have, I used to pay Nigerians then. Once it's above a certain amount, I convert to dollar immediately. I bring it back here. There's crypto, I bring it here, or I leave it in a crypto wallet. If I want to pay, I convert crypto back to Naira and I pay Naira bill. Doesn't make any sense, right? Doesn't make any sense whatsoever. So that's just my take. It's not rumor. Naira is, I don't want to say some words and all that, but Naira is not a store of value because of the expensive and wasteful spending of the Nigerian government. That's a true fact.
Thank you.
Oh,
thank you. And,
good copy. Thank you, Ogakalu. Before I hand over to Ogake, Ogakalu, we just want to thank you for coming out here today and really educating us. I'm sure some folks here will probably request for another session of this because it's quite interesting and the market.
Yeah, you guys will pay that time now. You guys will pay.
We'll pay. So before I hand over to Ogake, just so everyone knows, we have a reunion, North America reunion, EXJAM and EXJAW, coming up 29 July. So please mark your calendars and try and book your trips. Come with your spouses, your friends. Yes, sir.
Thank God you mentioned spouses. My wife is on this call. She raised her hand for a question.
Oh, please,
Okay.
who is this talking?
It's Udu that is talking.
Oga Udu, sorry, Madam
No,
Udu,
I
please
noticed
ask your
she
question.
dropped it, so I kind of stepped in.
Oh, my apologies. I'm so sorry, I didn't see your hand. But
That'll
Madam,
be-
I don't know
that's
your
fine.
name.
That'll be
Oh,
Nancy,
good
right?
evening.
Yeah,
Yes,
that's
good evening.
Nancy.
I actually saw your hand. I was waiting for him to hand over to me because I texted him, somebody's hand is up. Or he was just, that's how they put people in trouble.
Madam, I'm planting, I'm
Okay,
sitting on
no,
my
no
worries.
I don't want to.
Good evening.
I don't want to solve for
It's been a really good session for me. Learned quite a lot, and I was just curious: do you use derivatives in your trading or in your portfolio management? And is it something you would advise that someone should take up? Are there any extra benefits?
Yes, so derivative is derives its value from something. The most common derivative I use is just options, right? If I can buy and sell an option just to protect a trade that I've done. So if I think that Apple is going to go up and I buy a call, some guys are going to be technical. If I buy a call on Apple, I go and I buy a put on Apple as well, just to protect my investment, right? That's just what I do. So personally, I use it. But if you don't know what you're doing, that's where you lose a lot of money because it's times 100 and it's leveraged. So personally, that's what I do. If I take a trading position and I do a call, then I buy a put. So it's a covered call, right? For the trading part of it, yeah. But it reduces your profit. So overall, if I don't like it, I don't buy it, so I don't have to buy the call. Or I just do like a man in quote and I take my losses and I move on, But that's it's a good strategy to always cover your call. So if you're buying and selling, you can use those contracts, especially for dollars, right? You can do a dollar trade and then just buy the opposite reverse and cover yourself. Yeah, that's how I use it.
Okay, just a follow-up question. What platform do you like? How do you get access to these derivatives?
You have to be okay, if you use Robinhood, it's right there, right?
Okay.
Yeah, so if you Robinhood, you have to do buy and sell options. It's right there. If you go on it, you would see it there. But if you click buy, they will tell you, are you buying the stock or are you buying the option on the stock? They will actually ask you, then you can say, well, I want to buy. You say trade, you can do trade options. It's right there. So if you click trade options, you see buy call or sell call. I think Robinhood is very easy because they explain to you, if you're buying this call, this is when you make a profit, this is when you make a loss. So it's pretty easy. Like last year, when they announced the vaccine guys, they were announcing the guys are going to do the vaccines. Johnson & Johnson did not get picked, right? So in my mind, I was like, this is going to be bad news for Johnson & Johnson. I'm going to buy the put call, which means I have the right to sell that call, right? Because Johnson & Johnson didn't get picked. So immediately I woke up bed, I bought a put to sell 100 Johnson & Johnson calls. And I went back to sleep. And the call just kept losing money. So what did I do wrong? I went back and I pulled up Johnson & Johnson and I looked at their results. So vaccines is a very, very tiny part of their business. They were making the profit, but it's about 10% of their profits. So even if they weren't going to get that vaccine mandate, right, it wasn't going to affect their profitability. They had made more money selling the Panadol in China for the vaccine than selling the vaccine itself to Americans. But I didn't do my research, right? I just jumped on that, it's going to be bad news, so I sold the call and I lost a lot of money, right? So I'm just giving this example on how you want to use this call. It's best used to protect a position. If you are going unidirectional, which means you are trying to make that derivative call to make profit, it's really going to be a tough sell. You could get lucky, like imagine if you had bought oil, a call to buy oil just 2 weeks ago, when Russian and Ukraine guys were saying they're going to make peace, oil crashed. So if you had just bought that and said, these guys are not serious, I'm going to buy a call to buy oil in 2 weeks' time, it would have been a lot of money today. So you want to ask yourself, what do you think will happen to oil prices in the next 2 weeks? So and 2 weeks is going to be really what's going to happen in Ukraine and Russia. Do you think there will be peace? There's going to be peace, or it's going to crash. So you want to buy a put, right? But if you think they're going to just go nuclear, just keep buying your calls on oil because it's going to go up. So that way it's a strategy. You buy your call, you put your stop loss, and you move on.
Makes sense. Thank you. Thank
You're
you.
welcome.
All right, thank you, Nancy, and apologies for missing you.
No.
Yeah, good copy. Thank you. Ogaki, I'll hand over to you from here.
All right, thank you very much. Let me just make sure there is no other. So Cyril, your hand is up, but that's from the last time, and Ogago was correct. You have no further questions, I assume, confirmed?
Yes, sir.
That's true.
All right, thank you very much. So on behalf of the North American EXJAM, Kalu, we want to thank you for doing this for us. Every time you come and teach, there's just a wealth of knowledge that is passed on. And I don't know if I said this very long ago when you talked about yields and bonds the first time when our group was still Yahoo Mail. That was my first lesson on it. And ever since then, actually, I've always been able to explain to anybody I come across. So thank you for what you do. And for those who are listening, who are EXJAM in North America, we need you to bring your expertise to add, to the collective value of what we get, right? You have an area of expertise. You are the best that we know of in that area. You're the one who can explain how things work. It's that collective knowledge that actually lifts all of us up so that we all now have an idea of what to do, like on the basic level. And we also have somebody that we can go to when we need information around that area. So if you have not delivered any of these seminars, we need you. Period. I want that to sink in a little bit. If you have not delivered any of these seminars, we need you, right? If it's just that 1 hour or 2 hours that you give for the whole year, it amounts to a whole lot. So consider it. We're waiting for you. Send us, just send any of the expo some text, and we will make it happen. All right, so thank you very much, Kalu. So good it's always really nice to just hear your perspective when it comes to finance, and you always do a great job of breaking it down so that it's just really simple. So I personally appreciate that, and I think I speak on behalf of the whole group when we say we're always appreciative. And I know that everybody is busy, so for you to basically, as soon as I came to you, you were basically willing to make it work, whether it's a Saturday doesn't work, or Sunday, and so for that also, we are grateful. So any final comments from anyone before we shut this down? And Madam Nancy, thank you for coming. Now you know where, so now we know where to put money.
Sorry, real quick question. Oh, sorry, I got to carry on.
Sorry,
Okay.
Kalu, can we have like 30 minutes personal free service before we start paying?
For
I have some things
AFMS,
personally to talk to you about. Yes, sir.
for AFMS.
Yeah, about EXJAM, yes. 89/1074, sir.
No, I
Yes,
mean,
sir.
are you saying you want AFMS group or individual?
No. One-on-one with you. I do have a question actually, but I want to, discuss it offline.
Call that Maho.
Honestly, it's fine. Honestly, it's fine. It's just once it's a time. That's fine. Yeah, we can do it. Yeah, send me. We'll talk. You can do it right now. I think I'm free. But
Yeah, I'll call you right
let me just
after.
give you my
Then we'll bring
program.
out this million. Let's share this
Friday
million. No
night.
people to hide it with other
I do
Kalu on the side,
Nigeria
guys.
and America. Friday nights, I do Nigeria. I've done 2 sessions, US on Saturday. I just missed a session now on Twitter Spaces, literally before I came here. And I have a manager. Sorry.
No worries.
She's very, very insistent. I do not do anything with anybody. I mean, I said, this is my alumni. I don't want to hear that. So yeah. So if you do it right now, I can just this is the takeover from on all that.
Right.
Yeah. But once it's after that, so I don't think I'm being hard to get. It's just I have someone that done all this stuff for me. Yeah.
Right, I'll call you. I'll call you like in 5 minutes
Just
after.
give me a shot right now.
Right.
So,
Let me tell you what we'll do, right? So as at now, basically, since there is no actually you wanted to ask one final question because after this they'll charge you money. So ask now.
Yeah.
your money has nearly finished. So ask now.
My money has nearly finished. Okay,
Yes.
I'm grateful. Thank you so much for doing this for us. I know you suggested that there was this 36-month strategy around buying a property. Maybe I didn't hear that right, or if I did, that document, is it on your website or is it something that you're going to share?
I can send an email. I write for Nairametrics. If you just Google Kalu Nairametrics buying a property, I'll send it to you. I don't know who's I'm going to send to you.
Okay, so should we reach out to somebody and then that person is the one who collects it so that we don't start disturbing you all as individual? Maybe if we have one person that
give me one. So I don't like to post my stuff on the group because it's like a marketing. So, but all this stuff, if you give me who to send it to, I could send you the real estate one. The portfolio one is every week, just US market we talk about. We talked about Bitcoin big time on Friday because we saw what's going to go up. The Bitcoin price was going to go up. So I made sure I can't recommend, right? But I was repeating Bitcoin so someone would hear it and go buy it, right? So it's going up right now and all that.
So send it to you individually or just by WhatsApp?
I can send you the what's it called? On WhatsApp here, I can send it to the properties. Basically, if you are trying to move to the United States and you were in Nigeria and you had a 36-month time period, you could buy a house, right? So you have to do 4 things, do the stuff in Nigeria first. If you have a PFA, get all that stuff done. Then when you get to the States, we're talking about getting a job that pays you a salary with a pay stub. So you get a W-2, then building credit immediately. And we tell you how to build the credit. Even if you don't have even if you have a credit card, go get a secured loan from a community bank. So you have credit running. Make sure your score is above 700, get all that in there, get your letter from if your mom is giving you a letter of money to buy your house, get a letter from your mom saying, I'm giving this guy a gift. He's not going to pay back. When you do all that, once it's 2 years, you have your 2 years tax returns, your credit's above 700 because you took about 2 or 3 lines of credit, you paid on time, then you want to go and apply for a mortgage. Doesn't matter what kind of mortgage it is, just apply for one as a first-time home buyer. Don't look at the environment, try to get some that you can sell or rent out. So you get that one first. Then when you now really maybe have kids, you can then buy your real home in your school district, put out that guy for rent. Why are we talking even real estate? Why is it a thing? In America, you buy real estate for 30 years fixed. So you can buy ARM, but the most popular is 30-year fixed. In 30 years, inflation is going to go up, but your loan from the bank is going to be fixed for 30 years. You might pay higher property tax, but the loan is fixed for 30 years. So just think about it. It's a hack. You're paying the same loan for 30 years, but the value rises during those 30 years. If you rent it out, your rent also goes up during 30 years, which means you are basically, if you rent out the first one and buy your real mortgage, you can take your salary and service your real house in your real mortgage, but the other house you rented out, the guy that bought that house is actually paying you rent, which is going to service that rent. So you have 2 homes, you own 2 of them, you have technically 1 cash flow mortgage, and that's your retirement plan. When you retire, you can sell one, get a lot of cash, and do stuff with it. So it's a very, very good way of investing in the US. The pathway to wealth in the US is through a home. No other way. It's designed that way. Don't try to that's through a home. The white boys did it that way, right? So that's why they did redlining. Redlining was a racial thing. If it wasn't a true home, there will be no red line to stop Black people from getting homes. And if you look at wealth in America, wealth is in proportional to home ownership. So white people are richer because they own homes. And how is that possible? Home equity line of credit. You own a home, you get a home equity line of credit. You can borrow on your home at the cheapest rates in America. You can't borrow anywhere for that amount of time at that lower rate than a home. So once you get a home, that's wealth. It's on your account as wealth, even if you don't own it, right? Even if you own 1% of the home, you can sell the house, get the difference as equity to yourself. It's set up that way because that's how the white boys want it. So go out and get it as well, right? That's the whole idea. I'll send that to you guys to right now, and you can just share it. I'll send it in the group. Yeah, I'll put it in the group. Yeah.
Thank you so much, sir. Thank you.
Right. Any final questions now that you know that it's going to be more expensive after now?
No.
No. Well, let them ask the question now, because that's how they all want to. They want to hide the information they have and go and get the solution alone. Ask now or forever hold your peace, or rather pay to hold your peace. All right. So what we'll do is now we will shut down this, but just like if it was a physical meeting, the hall after that, the meeting is closed, but people still hang around, everybody says hello. So even though it will feel rowdy, it is because the meeting has officially ended. All right. So in the absence of any other one, you can now unmute yourselves and you can now begin to greet Madam. Well done. Thank you very much, everybody.
Yeah, Aya, do you want to stop recording?
Yes, I think we should do that. So you can stop recording.
All right, good copy.
So have you stopped the recording? No, it's still going on. Hold on a minute. Who's the host?
So you want to send the this slide to you?
Yeah, you can put it straight on there if you're okay with that.
Okay, gotcha.
Yeah. Since we all know it's
Kayode,
yes.
do we have access to this to the recording?
Yes, the recording is always available, but you okay, so now me too, I'm going to charge money. If you have not paid your annual dues, you will not be able to see it.
No, Wahala, sir. That's
because
I haven't paid.
Because you
haven't paid, right?
Those that haven't paid, exactly.
Okay, we never sort out that our own.
which is your own. You don't come. You know your madam is here. What are you talking about?
I know she has gone now, so I've come outside. Okay, I know. What I'm talking about is the Canada thing. I'm paying dues now. I've been
Yes. That would be. I think Tunde Shoboejo can answer that since he's our financial secretary.
Okay. Uduma, do you want me to answer that question?
Kalu give us free money. You give us free time. Now you want to pay your price.
Oga Tunde, I'm sorry to cut you off, Uduma. Oga Tunde, can I send you a check for my annual dues?
A check for your annual dues?
Yes, sir.
That's a very tough question. In an ideal world, we would prefer. So we have PayPal, we have Zelle, we have. I believe that this would be an exception to the process, but I think it's possible. I think it's possible.
Because the bank I actually bank with, they don't have that Zelle capability as yet.
Franklin, are you there?
I think we're still recording, but
yeah.